Thank you for that introduction. And I must say, despite me having my mask, I'm very pleased to see people today. It's lovely being able to do things face to face, etc. And I suppose my job here is to talk about what's happening from the less of DB perspective in the VBI world, which some of you may or may not be focusing on a lot. Some of you may or may not even know what I'm about to talk about. But it is really important that we do keep it in the back of our minds as to what could happen in the future, because while a lot of people would hope I'm going to stand here and say we'll never ever have a funding call again, I will never ever say that to you. And I think you should work on the basis of when, not if. And it's just a question of timing, because it is a function of defined benefits and the type of fund that we've got. So hopefully I will be able to drive this. No. No.
Just press the clicker.
The clicker. No.
That's good.
First set of slides for the morning, so.
2 years since in person, shows you're too used to being in front of a screen.
Unless it's one of those. No. Okay, pretend we've got this wonderful slideshow happening and we'll let it work. My next slide is actually our usual disclaimer to say anything that I say that may impact you or you'll think about it from your own personal perspective, please think about whether you should go and get advice as such. I'm actually talking about our VBI and our DB stuff from a finance perspective, not from a member's perspective. Just in terms of some background for those of you who aren't familiar with defined benefits or the loss of DB subplan, basically when you've got a defined benefit, there is a promise to the DB members that you're going to pay them a guaranteed benefit when they're eligible to receive it. And what that guaranteed benefit is based on is basically the person's salary and their years of service. So it doesn't reflect the investment returns of the portfolio supporting their defined benefit. They're actually guaranteed a benefit as such. While we have a long way to go before the loss of DB fund is wound up, and that's because we pay lifetime pensioners to eligible members, looks like we've got some action happening. LAS of DB has been closed to new members since December 93, so we don't have anybody coming into the LAS of DB framework, but we have a long tail before it gets there. As I said before, some of our members can take a lifetime pension. It's those members who were members of the fund before May 1988, and they can take up to 50% of their defined benefit as a pension. And what we're seeing and what we're continuing to expect to see is that the majority of people who are eligible to take a lifetime pension are actually doing that. Also too, when we've got loss of DB members who leave councils or whatever, they can park their benefits in our deferred benefit arrangement and take out their lump sum benefit at a later stage, or if they want to, they can move into the lifetime pension arrangement if they're eligible to receive it. Normally when you're dealing with, in the good old days, normally when you're dealing with defined benefits, all you were really worried about was the total service liability. And the total service liability is looking at when an orderly departure of all your members and when those benefits are paid out. And it was an actuarial thing. We would look at what advice the fund actuary gave us as to what the funding requirements were and manage things accordingly, because what we'd ideally like to be is when the last dollar has to be paid out of the fund, we've got $1 left. That's the perfect world and what we would ordinarily try to manage to. Unfortunately, when the GFC happened in 2008, and subsequent years, APRA got really nervous about this because there was a lot of DB funds that were getting into a lot of trouble, and they introduced a prudential standard, SPS 160, which is about the management of DB subplans and getting really specific in terms of the funding. And what APRA has done is that they've made the vested benefit king. And the way the vested benefit works is that you have to be fully funded, and there's a few exceptions, but basically what they want is that if all of your members left all on the same day, you can pay them all out. So that's a really big difference between the total service liability method and the VBI world. And so when we're looking at our funding at the moment, it's typically driven by the VBI, not by the actuarial method, bearing in mind that if we ended up being in call territory, we would actually negotiate or go and talk to APRA as to what was a sensible answer, because the last thing we need is to have a giant surplus on a TSL perspective just to satisfy the VBI. So that is something that we would try and manage in the event that we had to make a call, or when we make a call. For those of you that don't know what the vested benefit index is, it's basically the net assets supporting the LASIF DB fund divided by the total benefit liabilities for those members that are in there. The way the VBI works is we don't have to sit above 100% all of the time. We've just got to sit above 100% whenever the actuary is doing an actuarial review, and at all other times we can sit at our shortfall threshold, which is 97% at the present point of time based on the investment portfolio, etc., of the LASIF DB fund. When an actuarial review is underway, it's 100%. So always at 30 June, it'll be 100%. In the September quarter, so 30 September, it may or may not be 100% depending on whether the fund actuary has issued his actuarial report for 30 June each year. Now, if we do fall below the relevant threshold, it's not the end of the world. It doesn't mean there's a funding call immediately at that stage. What happens is that we have to kick off with some restoration plan work in terms of, do we need to have a restoration plan to get us back to the VBI within 3 years, 100% within 3 years? And that might involve a variety of things. So one of the things we do is we get the fund actuary in to do a review. That's going to take a bit of time, not forever, but it's a 3-6 month piece of work depending on what he's got to do. The solution and while he's doing that, we might get back to 100%, in which case there's nothing to happen. If we're not back at 100% at that stage, it could still be a wait and see plan. It could be, we'll wait and see what the investment markets are doing, because they might just bring us back naturally to the 100% over the 3 years. It could be that we look at increasing the additional contributions that are paid each quarter. Could be funding call, could be a combination of all of the above, and there could be a whole lot of other things in there, including talking to APRA about the time period, talking to the state government, all those sorts of things. So when you look at our VBI, it is going up and down all over the place, and the VBI numbers get close to the shortfall limit when we get to 30 June, but our VBIs in LASIF DB are fluctuating primarily based on the investment market performance. So as you can imagine, since COVID started, it's been fairly exciting. Bearing in mind, if we were really worried, we would be sending you out regular updates, like when COVID started. For those of you who were around then, there were the regular updates coming out, just to give you an update as to what's happening with the markets, and they were every couple of weeks. with the Russian-Ukraine situation and where we're at the moment. We are monitoring our VBI on a daily basis, but we're hovering around the 105% mark, so I'm not losing any sleep yet, so I'm not creating you guys an issue in terms of you losing sleep with me. So when we've got an actuarial review on, we've got to sit at the 100% mark for the VBI. All other times it's 97, and if we fall below the relevant shortfall, we just kick off a restoration plan review, so it's not too bad. The last actuarial review at 30 June last year was an annual review because we pay out lifetime pensions. The last triennial review was 30 June 2020. And if you go to our website, our DB section of our website, you can download a full extract of, or it's not a full extract, it's a full report from the fund actuary if you're interested in that. The assumptions that we use for 30 June 21 for the VBI are up there at the moment. These are likely to change for 2022, and unfortunately the net investment return is likely to go down, but that's just a function of what the investment markets are doing. The results from last year, and the one to get excited about is the 109.8. The other two numbers there are not relevant from a funding perspective. They're things that we're required to get from a legislative perspective. So last year the VBI was 109.8 and had gone up from the prior year, largely due to the financial experience being better than what the assumptions were predicting we'd have. So we had excess investment returns above the salary increases and the price inflation for the year. This year I'm expecting the VBI to go down. As I've already said, we're sort of hovering around the 105. It'd be nice to see 110, but it's better than 100. We take everything that we can get. Now, from a funding perspective and what it means for you guys in terms of money that you've got to pay to us, it really is the investment returns that are determining what the outcomes are going to be in terms of the VBI and the total service liability. And just to give you an idea, the fund actuary included this in his report in terms of a VBI projection. This is just assuming that the first year of this projection there was no investment returns as opposed to the 4.75, and that every year thereafter there would be, the investment returns would be as per the assumption, and as you can see it makes a big difference to the VBI number over time. And of course once you do year on year it just fluctuates all over the place. Don't read any of the detail in there, but that's just to reinforce how it can go up and down just based on what the investment markets are doing. That's what we are concentrating on, and the investment guys are certainly focusing on that. So where to from here? So the investment returns are the drivers for our VBI. Can't see too many other things going to have a major impact on the VBI, unless we had a run on benefits being paid out or massive salary increases, but all of them would have to be pretty big. At the moment, if we have a 1% change in the long-term investment assumption, that means a 5% change in our VBI as our rule of thumb. A couple of years ago, I would have been saying to you 1 to 3, so we're now at 1 to 5. And then so what that means from our end in terms of what we're trying to do is that we're trying to build up the VBI margin with good returns, or as good as we can get. Once it's up around 110, bit more, etc., because of this kind of drop, we would then look at trying to take investment risk off the table. Unfortunately, the drop in the long-term investment expectations means a drop in the VBI, as I said, at the moment 1 for 5. And it's immediate hit. So getting that timing right is really critical when we do it. And then basically go into a repeat, build up the VBI, take the risk off, etc., etc. What we do have to do, though, is bear in mind that with the lifetime pensioners, their pensions increase with CPI, which means that as CPI is going up, we need more investment returns to be able to make the pension liabilities. So as you can imagine, it's a pretty fine balancing act where we're trying to take risk off the table, but still trying to have sufficient growth to cover the pensions. So we're actually not doing a call just to cover the pensions. So the key factors that our investment team are looking at the moment in terms of the investment environment is what are the central banks doing, what pressures, inflationary pressures are we trying to manage, etc. COVID-19 still impacting everybody and its variants. Nothing's got back to normal as such. And then, of course, we've got climate change that we're looking at. So without wanting to depress people too much, the investment outlook from the investment team is, we're experiencing negative effects of significant monetary inflation, so that's putting pressure on everybody. We want to see it actually brought under control because that'll make our lives easier. In terms of the US, our investment team think that there'll be a moderate recession, although that's not certain, but talking to the guys today, they were talking about we're living through the 70s at the moment, which brings to mind a certain popular song at the time, and it does make life interesting for people. And also what we're seeing is that the equities are expected to fall further, and the medium investment outlook has improved reflecting the fall in valuations, but then there's also the inflation control piece that sits in there. Ultimately, from a VBI perspective and funding the DB plan, the above's all got an impact on both the actual returns and the financial assumptions. We generally monitor the VBI on a quarterly basis, but when we actually have periods of market volatility, we either kick into weekly and or daily monitoring, and then depending on how significant those variations are, we will get more and more scientific with the monitoring that we're doing. So at the moment, we're just watching the investment movements. We're not actually also factoring in all of the benefit payments that are happening, salary increases on a daily basis. The markets get a bit more crazier, then we might go, right, that's what we've got to start to as our next piece of exercise. What does that mean for 30 June 22 actuarial investigation? We're expecting downward pressure on the VBI, and at the moment we're expecting that once the 30 June 22 assumptions are locked in, the VBI will decrease by 1.5 to 1.75%. So that would still, sitting around the 105 mark, we're still above the 100, so not the end of the world at the present point of time, and also not at a point where I'm losing sleep. So when I start sending you messages, or we start sending you messages, you know that there's a bit of sleeplessness happening, at least from some of us at Vision Super. The estimated VBI for 30 June is expected out mid to late August, and the final report from the fund actuary around October 22. Of course, that raises questions for you guys as to your external audit, your auditors, and what sort of information that they need. They can ring me at any point of time, or you can ring me at any point of time, or send me emails. More than happy to talk to you. But basically, you look to use what's publicly available information. We will also update our sample employer note with the assumptions once they're finalised, and that's available on our website. So if you have not ever found our website that has a whole lot of DB information on one page, make sure you go and visit, because that's the stuff that is actually publicly available and has been released as such. So good luck for 30 June. Happy to take any questions. There's at least 1,500 in there, so we've got about 4.5, and I'm probably not being as accurate as I could on that piece. There's still a sizable number in there.
So what's the impact of the super guarantee?
The super guarantee has no impact on defined benefits. Effectively, the accrual rate for the LASF DB members is about 18% and has always been. From a funding perspective, and the fund actuary, when he has issued the contribution rate, he has just picked the SG rate as just being an easy number that prima facie shouldn't confuse employers as to are they contributing an SG rate for all of their employees, but for DB members it's not SG contributions. So it is just, that is the rate that the fund actuary has thought would be an appropriate rate for contributions to be made to the LASF DB, but it does nothing to increase the benefits of those members because their actual accrual rate is about 18%.
So from the fund's perspective, it's getting more money from the council for the SG rate going up.
From the fund's perspective, it's getting more contributions from the councils because that is the rate the fund actuary has recommended, which just so happens to coincide with the SG rate. What that means is that little bit of extra contributions coming in takes a little bit more pressure off the investment returns that the fund has to earn to satisfy the funding requirements. And I'm happy to have a discussion offline with this if you want to go into it in a bit more detail. I'm happy to talk to anyone about it, but the SG is not related to the DB benefits or the amount of the DB benefits the members are getting.
Noel, Danny Wayne from Monash over this on this other side. Sorry, if you remember the living in the 70s, you're probably a DB member.
No, I want one.
Yeah. Noel, two questions. One is you mentioned that the VB index covers, if it's in positive territory, it covers the liabilities of the scheme. But that's, as you said, was that to pay out the scheme, pay it out? So it doesn't actually cover, you know, long-term pensions and stuff, does it?
No. So while it would be nice to go, if we've got 100% VBI, we can just close the fund, end of story, everybody gets what they're entitled to. It actually doesn't take into account a whole lot of factors, including what the members would have otherwise got at some point of time, what the pensioners are getting, and I suppose LASF DB used to be under the state government, and the state government, when it set us up, basically have said LASF DB should always operate as it was originally intended under the state act that was put in place at that point of time. So having a VBI above 100% doesn't mean that we can actually satisfy the liabilities that really ultimately would be payable if we had to pay them.
And another question, Noel. A number of councils now, having lived through the two big calls, and our last one was $12 million for our council back in 2012, and when we were in a reasonably good position 3 or 4 years ago, we decided to start putting a discretionary fund away and build up a DB fund. Now, I'm not sure, just maybe ask for your opinion on that. I'm sure Vision don't have a formal opinion on that, but what are your thoughts in terms of councils that are putting money aside, or at least discretionary funds aside, in the off chance, not say off chance,
on the when question,
or the likelihood of a call?
Yeah. I can't tell you guys how to manage it from your end, but I would always say it's a question of when, not if, and definitely not never. And I wasn't at Vision Super when the last from a variety of angles in relation to that call, and prima facie, I would be putting aside something. And so Vision Super has our own DB obligations under the fund. So I feel your pain. So I always, I think you've got to prepare yourself for when and what do you need for the when. And I was thinking about it on the way down here, like I'd love to say we're never going to have it. A lot of it is sequencing risks, and it's 10 years since the last call, give or take a year or two. That prima facie has to mean the next call is closer. Now, whether it's next year, based on the current numbers, I'd go no. But if the market's completely tanked and we ended up with the VBI around 80% and there was no hope of the investment markets recovering within 3 years, et cetera, we would be doing a lot of talking with APRA about what the restoration plan should or shouldn't look like for loss of DB as such. So the last two calls, we've had a 10-year and a 15-year period to be able to get the payments in. The current 160 rules say 3 years. We would certainly go into bat to try and get something that's not 3, that it's closer to the 10 or the 15. Whether APRA would even listen to us, I don't know. But you should be thinking about the when as opposed to anything else. And I suppose the other thing is with the rate capping, if we thought we were going to end up with the rate capping side of things, we would work with you guys with the state government as to what how the call may or may not fit into the rate capping world as such.
One more question, I think.
Yep.
Thanks very much for your presentation. My name is Amanda. I'm the CFO at Moreland City Council. Just following on from the previous question, there seems to be a lot of variation across councils in terms of how they're anticipating the when. So as was mentioned, reserve accounting and actually holding funds aside is certainly one method we see. But there's also that consideration for future borrowings capacity that might be needed. Is there any availability of data that would help us to determine, even if it was, in terms of a model, what a decrease of 1% would actually look like and how that would be split across the group so that we can make our own estimates as to how big the bucket or the reserve needs to be?
I wish there was. This is something we have looked at numerous times as to whether or not there is a model that we could give you that you could use to build in your own assumptions, come up with what you think your answer might be. Unfortunately, because loss of DB is a real pool, as in it's not based on, ultimately it's not based on how many DB employees have you got, and that's your part of the pie. We can't give you, we just can't give you anything that even from our end we could go, it's not leading you up the garden path, because the way it works is that there is a formula for one part of the benefits, and a formula or the call, and a formula for another part of the call. Ultimately, the less DB members you have, the more you're falling into the first part of the formula, and there's nothing I can give you that I can go, right, I'm confident that this isn't going to lead you up the garden path, because you're one employer of 150 plus who would be involved in a call if we have to make it. And I suppose this is an important thing, because some of you might not realise it. If you have no DB employees at the moment, that doesn't mean that you won't be part of the call, because the call reflects the employees, DB employees that people had back in 93, one way or the other. So even if you have no DB members with us at the moment, you will still get caught into the call one way or the other, because at the time you had DB members and DB pension obligations at that point of time. So there's no free kick here. And yeah, we've thought about how can we give you a model. Is there a model that we could give you that would be meaningful? And we haven't been able to work out something that would work. We'd need all of you to give us all of your assumptions, and you'd have to have them all the same assumptions for us to even go, does this even make sense?